Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the amount of debt that was announced just now that was going to be issued into the end of the year is unbelievable. We've probably jumped the shark, crossed the valley of death. We're going to talk all about it. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So Bob, a lot of information has kind of come out in the last 24, 48 hours, and really we're just seeing some really unprecedented things with debt, aren't we?
I mean, my jaw dropped when I saw it. Basically, all our conversations about the reverse repo, there's going to be no more reverse repo by the time Janet Yellen gets done with it. I mean, literally what she announced would wipe out the reverse repo, and then she has to turn around and hope and pray that people buy her T-bills that are going to expire here in October, November, and December.
Right. Yeah, if we segue to this chart here, you guys can see where we are with total debt. I mean, it's just skyrocketing. And if you look there, it's kind of projected out with the dashed red line there. She's adding another 1.89 trillion of debt in 5 months going into the end of the year. We've never seen anything like this. This is just unprecedented debt issuance. And I think what we're ultimately going to be seeing is stress in the bond markets. And that's never good for the market.
We've crossed the Rubicon. Every time we've gotten to this level on the 10-year, we sold off. You know, this was a sell-off into October. Then we had the mini dump in March, and now we're climbing right back up there again. And if I could expand this chart back to 2007, 2008, we had a similar double top situation happen that really basically was the foment. 2006 was the first top. 2007 we double topped the 10-year, and then great financial crisis resulted in it. And we're repeating the same pattern again, except this time I think we break through and we blow this double top off. I put a fib line up there saying that the math tells you 5.19% on the 10-year. Realtors are going to be working McDonald's. So, do you want fries with that escrow? Because it'll literally lock down the home markets.
Yeah, and Bob, bank lending's collapsing. That's something we can cover probably later in the week. But one thing to note on this TNX chart is that, my thesis is that if we're going to have the traditional yield curve normalization, then we should see the 10-year climb. And so my thesis is that if we do crack a new high here, which is getting over that 4.33 level, we're basically confirming recession, because typically you get a steep yield curve normalization that goes and takes you all the way up, confirms recession, and also confirms the market rolling over. No more highs as the yield curve normalizes, and it should normalize in a very steep way. So I do agree with your projection up there over 5%. I think it could go more, but it could be a combination of that and then also that the short end of the curve, the 3 months and under a year, start to fall back.
Yeah, and then basically all hell breaks loose.
Right. And then you had another chart too, Bob, right, about the Japan market. The Bank of Japan has really shifted their policy from decades of just accommodating to now starting to hint that they're going from an accommodative cycle, and this has been a long cycle, to one of tightening. And now all of a sudden the Japanese 10-year yields are jumping up. And that's another thing too, that typically when the Japan yields are going up, it usually has global yields following suit. And, so they're looking at maybe another 0.5%, but they're very ambiguous, right, on what they're going to do. Like they're hopping in here and there. Like yesterday, I think they did an emergency bond buying, and the market said, yeah, too bad. Yen dumped even more and yields jumped up even more. So it's almost like we've got a potential contagion on our hands, because if the Japan loses control of their bond market, you will feel that through every asset class around the world, and you'll feel it quickly.
Yeah, so this chart I put together here, the United States is the number one destination for Japanese investments. You got $224.8 trillion of yen in our markets. I don't have the exchange rate in front of me. Just trust me when I say it is a lot. And, some of that's stocks, some of that's bonds. And they're going to have to, they're not going to have to repatriate. They will repatriate because the yen will strengthen and the carry trade will become unprofitable to maintain it in US dollars. And they're going to have to push it back into yen back home. And this is the last of the carry trades, as Phil's been telling you guys for months and months and months. And when this thing rolls over, then it's Katie bar the door, and this is probably where the credit events are going to start showing up, when the Japanese have to stop supporting us.
Right. And, Bob, credit events, typically there's a seasonality to them. They either happen somewhere around October, November, or in March. For whatever reason, that's seasonality for big credit events in the market. So it'll be interesting to see as we go into Q4, because you and I both have had a pretty bearish view going into that, how things shake out, and whether or not Japan's market really sets things off for us. Already, I think we're due for a pullback this month, and much of what the fuel was for this market move, the T-bill issuance, today's actually the last day for that. So now we have a bit of a windfall under us that could potentially backfill.
Yeah, and look at Phil, if this is the last of the T-bills, Yellen's going to have to pay more for the T-bonds. And I think we're seeing that showing up here with the movement in TNX here in the 10-year yield, is that these bankers, remember, they have to buy it, but they don't have to buy it at the price that comes out. They could force higher yields. And that's what's going to happen. And I think when that happens, then it's going to be a crowding out effect for the stock market. So, think about it. If you're a pension fund or an insurance company and a retirement fund, and you're starting to layer in 5%, 6% fixed rate money, knowing over the term of that note that you're probably going to be able to sell it for principal appreciation on top of it, you're going to start shifting away from stocks into bonds. And I think that's what I think Powell's been waiting for.
Yeah, later in the week, we'll go over why yield curves matter, because I think all of this is starting to come to a head now. It's just we're getting into that last half of the year that we've been talking about for several weeks now. And so it's going to get really important as far as what happens in the bond markets relative to everybody's portfolio. So with that, Bob, I think that's going to wrap it up. And I'll see you guys tomorrow. Bob, thanks for the charts and explaining all that for us. We'll see you on the next video. Please hit like and subscribe. Check out tradegenius.co for our newsletter and specials. And we'll see you tomorrow. Bye-bye.